This presentation discusses fiscal policy. Fiscal policy is the discretionary changing of government expenditures or taxes to achieve national economic goals such as high employment, price stability, and economic growth. An increase in government spending, as we've seen, will stimulate economic activity. Changes in government spending include things like military spending, education spending, and budgets for government agencies. In this graph, we can see that by expanding government expenditures, we increase aggregate demand, which pushes our long-run aggregate supply out along the short-run aggregate supply curve, increasing price level and real GDP. Conversely, if we decrease the aggregate demand by decreasing expenditures, then the opposite happens. So, would the increase in government spending equal the size of the gap here? And what impact would expansionary fiscal policy have on the price level? Now let's consider a change in taxes. A rise in taxes would cause a reduction in aggregate demand because it can reduce consumption spending, investment expenditures, and net exports. Here we see a decrease in taxes, which is increasing aggregate demand and causing the long-run aggregate supply curve to shift outward, increasing the price level and increasing real GDP. And conversely, here we see an increase in taxes, which decreases aggregate demanded and thus pushes down long-run aggregate supply, decreasing real GDP and the price level. So what would we expect the long-run impact of a tax cut on real GDP to be if the economy is at full employment equilibrium? We also need to consider the circumstances surrounding the fiscal policy. For instance, how are expenditures financed and by whom? If the taxes are increased, what are we doing with those taxes? And what will happen if individuals worry about increases in future taxes? The crowding out effect is the tendency of expansionary fiscal policy to cause a decrease in planned investment or planned consumption in the private sector. This decrease normally results from the rise in the interest rates. In this chart, we can see the typical process for the increase in interest rates. First, the government spending exceeds tax revenues, so the government deficit increases. Then government seeks more funds from savers to finance deficit. Then, to induce savers to provide those funds, the government must offer a higher interest rate. Fewer private investment projects are undertaken and there are fewer purchases of homes and cars. Government spending crowds out private spending, and this is the crowd-out effect. Here we can see graphically how the crowding out effect might change our calculations. In fact, with an increase in aggregate demand, it might be pushed back by the crowding out effect and lead to a smaller than expected increase in real GDP and the price level. The Ricardian equivalence theorem states that an increase in the government budget deficit has no effect on aggregate demand. This is because people will anticipate that a larger deficit today will mean higher taxes in the future, and they'll adjust their spending accordingly. The permanent income hypothesis suggests that an individual's current consumption depends on anticipated lifetime income. So a temporary tax cut will have a restrained effect on aggregate consumption. Direct expenditure offsets are actions on the part of the private sector and spending income that offset government fiscal policy actions. Any increase in government spending in an area that competes with the private sector will have some direct expenditure offset. Let's consider supply-side effects of changes in taxes. Expansionary fiscal policy could involve reducing marginal tax rates. The advocates of this argue that this increases productivity since individuals will work harder and longer, save more, and invest more. The increased productivity will lead to more economic growth, they say. Lower tax rates lead to an increase in productivity because individuals will work harder and longer, save more, and invest more. Increased productivity will in turn lead to more economic growth and thus higher real GDP. As a result, lower marginal tax rates will not necessarily reduce tax revenues because the tax base will be larger. The Laffer curve is based off of the idea that there is zero tax revenue at exactly 2 points, 0% tax rate and 100% tax rate. Given this, then there should be at least 2 points for any tax rate such that the tax revenues are equal. a higher and a lower tax rate, so long as we're not at the optimal taxing point. So, is the conduct of fiscal policy as precise as it appears? The problem with this is that the conduct of fiscal policy often involves a variety of lags. Time lags, such as recognition time lag, the time required to gather information about the current state of the economy. Action time lag, the time required between recognizing an economic problem and putting policy into effect. This lag is particularly long for fiscal policy that requires congressional approval. And the effect time lag, this is the time it takes for a fiscal policy to affect the economy. So fiscal policy time lags are typically long. Policy designed to correct a recession may not produce results until the economy is experiencing inflation. They're also variable in length. They can last 1 to 3 years, and the timing of the desired effect cannot be predicted. This is because fiscal policy time lags tend to be variable. Policymakers have a difficult time fine-tuning the economy. Automatic or built-in stabilizers. Changes in government spending and taxation that occur automatically without deliberate action of Congress. Some examples are the tax system, unemployment compensation, and welfare spending. So how does the tax system help? Well, incomes and profits fall when business activity slows down, and the government's tax revenues drop as well. Some economists consider this an automatic tax cut, which therefore stimulates aggregate demand. Unemployment compensation and income transfer payments. Unemployment compensation reduces changes in people's disposable income. Their disposable income remains positive, although at a lower level. In a recession, more people are eligible for income transfer payments and do not experience such a dramatic drop in disposable income. Stabilizing impacts. The key impact of these systems is the ability to mitigate changes in disposable income, consumption, and the equilibrium level of GDP. If disposable income is prevented from falling as much as it otherwise would in a recession, the downturn will be moderated. During normal times, Congress ends up doing too little too late to help in a minor recession. Fiscal policy that generates repeated tax changes, as has happened, creates uncertainty. During abnormal times, fiscal policy can be effective in some circumstances. During the Great Depression, fiscal policy may be able to stimulate aggregate demand. In wartime, during World War II, for example, real GDP increased dramatically. We may also consider the soothing effect of Keynesian fiscal policy. In the event of a severe downturn, fiscal policy is an option. So knowing this may reassure consumers and investors, which stabilizes expectations and encourages a smoothing of investment spending.